Welcome to the On Your Side podcast. I'm Gary Harper.
And I'm Susan Campbell. Home ownership is the American dream. You save up for a down payment, you find a house you can afford, and then you buy it.
But there's a lot more to owning a home than just the mortgage payment. There are unexpected maintenance issues and other expenses that former renters are not used to paying.
So today, Jeff Ostrowski joins us on the On Your Side podcast. He's with Bankrate, and his research reveals homeowners pay around $18,000 a year to own and maintain a home. He explains what you can do to cut those costs.
This is On Your Side with Susan Campbell and Gary Harper, an Arizona's Family Originals podcast.
Welcome to the On Your Side podcast. I'm Gary Harper.
And I'm Susan Campbell.
Home ownership, it's the American dream.
It is. It's fun.
Yeah.
Sometimes.
Your first home was actually a condo, right?
Yeah, we bought a condo in Providence.
Okay.
2015. Got a screaming deal on it because it had been on the market for 400 and some odd days.
Oh, my goodness.
I know.
Man, so you snatched that thing
up.
We
did snatch it up. And then a couple of years later, we were able to sell it for a nice little profit and turn it into our house in Rhode Island. And we turned that into our house in Arizona.
That's
we kind of got lucky on this roller coaster of real estate.
They say real estate is, it's great to build your wealth. So
I'm not going to go that far. We're not going to say building wealth, but we can pay the bills.
It beats, I guess, trying to save and save and save. I mean, home ownership it's got a lot of pros and it has a lot of cons. I remember I bought my first house. I was 27 years old. I was in Grand Rapids. It was a 950 square foot house.
Did you feel like the king of the world?
I did. I thought it was really, really cool, but, it was really small. I mean, think about that, 950 square feet. But you know what? It was mine.
It was yours.
You
could do whatever you wanted with. There was no landlord to say, Gary.
Listen, I kept that lawn looking good. It was green. Except in the wintertime. It was Grand Rapids, I told you. So,
that's under snow all the time.
That's like 8 months of snow. I remember trying to dig out of my garage, and then when I come home from work, I'd have to get all the snow out of the driveway as well. So.
And you never looked back. You moved to Arizona and said, no, thank you.
Yep. My wife said, here's a line across the United States. Get me a job anywhere below this line, okay? So, and
Smart lady.
I wound up in the hottest place in America. So listen, let's talk a little bit about home ownership. And there's some things that go along with it that people just really are not prepared for. In your condo, were you prepared for everything?
There was one thing we had to make a tough decision because there was going to be a window replacement assessment, and it was an old historic building, and that was one of those things where we were like, oh, we are not ready for this because it had to be a specific kind of window and this and that, and like all of a sudden, my goodness, those costs added up really fast.
Yeah. Were you expecting that or?
No, we weren't.
Oh, man.
That was after we bought it. And it wasn't one of the things it wasn't like a seller didn't disclose or something. It just came up and we had to find out the hard way that was a possibility. We were able to sell before that assessment was a requirement. The new owners knew about it. We told them and they were fine with it.
Oh, thank goodness. You didn't get stuck with the bill then, huh?
No.
Well, today we're talking to Jeff Ostrowski. He's with Bankrate.com. Hello, Jeff. How are you today, sir?
Hey, I'm good. Although I'm, now that I'm thinking about all the money I've spent on home repairs over the years, maybe not so good.
Oh, no, I know. We just put a new roof on our house here, and so I can commiserate with you a little bit about that.
Not only did you just put a new roof on, but not long ago you had windows
We did
installed.
the windows. Yeah, well, everything on our house was built in 1995, so everything kind of hit that Arizona sun has been beating down on it for a lot of years, and it's time to do all of it.
Between the windows and the roof. Were you expecting that when you bought the house?
Yes, we knew that was coming.
Okay.
But I'm going to keep my job so I can keep paying for these things.
You got to have something coming in. Jeff, tell us a little bit about home ownership. And you did some research, which was rather, intriguing. So tell us a little bit about your research and what did you find with home ownership and these expenses that people are not expecting?
Yeah, so we estimated how much it costs to own a home. So these are the things beyond the price of the home itself, the monthly principal and interest payment. So we threw in some obvious things. We call this the hidden costs of homeownership, but the property taxes and homeowners insurance premiums, those aren't really hidden. We also threw in electricity bills, But I think that the big one that comes as a surprise to first-time homeowners is the ongoing repairs and maintenance. I mean, you got to constantly do things like replace appliances, the paint, fix things up, call the plumber, call the electrician, replace the roof, replace the windows. And so all those things really add up. So we estimated that as of earlier this year, the typical American homeowner is spending about $16,000 a year on all of these things, maintenance, repairs, the property taxes, insurance. And that's up about 26% from 4 years ago, the beginning of the pandemic. So it's certainly up pretty dramatically, and up even more than inflation over the past few years.
That's a hefty price tag and a hefty jump, and frustrating for a lot of homeowners who are trying to make it work. They have saved and saved and saved to collect that down payment.
Mm-hmm.
And then all of a sudden you don't think about, oh my goodness, I have to change all of the air filters
Well, that's cheap.
all the time. But
Yeah.
it's those little things that do add up all the time.
Well, like Jeff said, I mean, unexpected. I mean, your refrigerator goes, kaput. I mean,
Thousands of dollars.
that's a lot of money.
Pay up.
I do have a confession here for you and Jeff, and that is I am not a very handy person. Okay, so my new friend, though, I discovered over the years of home ownership is YouTube. So the dryer went out. Instead of calling the repair guy,
You figured out how to fix it?
I went to YouTube and I figured out how to fix it.
I'm very proud of you. And your house is still standing. It didn't even burn down.
The dishwasher went kaput. Got onto YouTube, figured that out. That saved me probably that was a dishwasher pump. That probably saved me $300. So
Nice.
I'm not very
you,
handy
Gary.
and I'm cheap. So, hey, Jeff, when people get into a house, I think they kind of get in there, like Susan said, with, they scrunge together every little bit of money they can for that down payment just to kind of get into the game. And, they're so used, if their dishwasher goes out in their apartment, they just call the landlord, or if their AC isn't working, they just call the landlord. Are new homeowners, do they prepare or not?
No, I think it's a surprise. I mean, even for me as a longtime homeowner, I'm still just amazed and shocked by how often I'm shelling out, how much things can cost. But I think really we sort of geared this research towards first-time buyers, because they're the ones who are sort of going into this not quite realizing how much these costs are going to add up. And as you said, for a lot of first-time buyers, they sort of think of getting to the closing table as reaching the finish line. So I've scrimped and saved for the down payment. I managed to qualify for a mortgage, and now I'm done. And really, it's just a starting line for another financial race, a much longer race, which is that you're just going to have these ongoing costs. I mean, on average, $16,000 a year that you're going to have to fund as a homeowner.
You have a formula that I think is kind of interesting, kind of like the 2% formula. Can you explain a little bit about that and how that applies maybe to a new homeowners?
Yeah. So for these numbers, like some of these stats that we threw in here are very specific. So we know how much the average property tax bill is in Arizona. We know how much the average electricity bill is in Arizona. We know how much the average homeowner's insurance premium is. So those were all very knowable numbers. And so we included that in our total. But then the other one, the biggest cost is just ongoing maintenance and repairs. And we use the 2% rule of thumb. So 2% of the purchase price of the home is how much you can expect per year on maintenance and repairs. And as Susan, as you were mentioning, you just did the roof and the windows. So I'm sure you spent way more than 2% of the price of your home this year. And then in other years, maybe you're just replacing the air filters, or doing some lawn care or getting the pool cleaned or whatever it is. So the 2% is just sort of an average number. It's not going to be 2% every year, and it also depends on the age of the home. If you're in a house that was built in the past few years, you're probably not spending a whole lot on repairs and maintenance. If your house is 50 years old, then yes, you are spending money on repairs and maintenance. So just an estimate, just a rule of thumb. But on average, we came up with an estimate of about $16,000 a year.
And that 2% rule, explain to our listeners how that would affect. So let's just say the average Arizona house is $400,000, just for round numbers. So it would be the 400,000 times the 2%, and that would basically equal what you should be, or what you're probably going to be spending on issues.
Yes, yeah. So the $400,000 house, you would expect to spend about $8,000 a year on maintenance and repairs. And again, with the caveat that these things don't break on a convenient schedule. So the AC is always going to break on the hottest day of the year. I guess the roof is one that you could probably plan for. Roof and windows, you can sort of push those out and do it when you're good and ready. But a lot of these things are just sort of emergency repairs. But yeah, exactly. So a $400,000 house times 2% would be, expect to spend about $8,000 a year.
I remember coming home from work 2 summers ago, and I walked in, and it was just the dogs there. The wife was out of town, and the AC had broken.
Were the dogs just roasting?
Well, they're Chihuahuas, so they love the heat.
But
they were
still,
fine. And
in Arizona,
I walked in. It was about 6:30 at night, and I was like, "Oh, this is not good."
it just smacks you in the face.
Oh, it was like, please just be something like really easy. And yeah, it wasn't. But the good news is I got the guy out there. He was heading home. He worked for a huge company that we trusted, and he was actually leaving his last service call, but he came by our house. I was like, oh my goodness, thanks.
Just wanted to give him a giant hug.
Oh, I did. But
AC is the one thing you cannot, you can't
play
put
around.
off.
No.
You can't put off that repair. If that happens, that is the immediate call, because it gets dangerous.
Yeah.
It's not like you can just open the windows out here, but
no playing around. Hey, we're going to get to Arizona expenses here in a little bit, but this really doesn't come as any surprise, Jeff, that Hawaii is the number one most expensive for these maintenance expenses.
Yeah, and a little bit of a surprise, because when we ran the numbers 4 years ago, California was number 1 and Hawaii was number 2. They've switched spots this time around. And that's mainly just a function of the high home prices in those two markets. If you apply the 2% rule, you're going to have to spend a lot of money. Those are also states that tend to have fairly high property taxes, fairly high electricity bills, and in California, especially, the homeowners insurance is going up. So in both of those states, you can expect to spend about $29,000 a year. And then at the opposite end of the spectrum, in a state like Kentucky, you might spend only $11,000 a year on these hidden costs of homeownership.
So when you are looking at a new mortgage payment, how do you kind of budget in for all of these things? What do you do to kind of stretch the budget, make it work a little bit better? Can you put off some of the things that you may think, oh, I have to repair this right this second? What are the things we can kind of put on the back burner maybe?
Yeah, so some of these things you're forced to budget for by your lender. So your lender will make you very aware of how much the property taxes are expected to be, how much you can expect your homeowner's insurance premium to be, and those things can go up. So they're not as locked in as the principal and interest on a fixed rate mortgage, but those don't come as a complete surprise. And when your lender's underwriting your loan and crunching the numbers, they're going to make sure that you can afford that. But the lenders often require you to have some kind of cash cushion, because they don't want you to get into a position where you move into the house 6 months later, you need to do some repairs, and then you're running up your credit card balances at 20% a year. So there are some safeguards built into the mortgage process. But I would say we talked about how first-time buyers are scrimping and saving for the down payment. After you close on the house, you still need to keep setting aside money for all these repairs. And at some point you're going to have a big one. So you just want to make sure that you've got some way other than a credit card that you can pay for it. So the best thing to do is to start putting money into a high-yield savings account as soon as you move in. And that's just your emergency fund for some of these repairs. And then once you've been in the house for a few years, you've got some equity to tap. Back when mortgage rates were low, a lot of homeowners did cash out refinances, which means you just pull some of the cash out of your house. Now that mortgage rates are at 7% or higher, it doesn't make sense to refinance the mortgage at 3%. So a lot of homeowners instead are funding these repairs with home equity loans or home equity lines of credit. And that's a perfectly responsible, acceptable way to pay for some of these big repairs. If the kitchen really needs to be renovated, if the roof needs to be replaced, if you've got a significant bill coming up, then a HELOC or a home equity loan is certainly a reasonable way to pay for it.
Do the quick crash course in math for somebody who doesn't know what those terms actually mean. This is their first home or first purchase. HELOC, home equity line of credit. What are we talking about?
Okay, those are just essentially second mortgages. So if you lived in the house for a while, you've built up some equity. So you've got, maybe you paid $300,000 for the house and now it's worth $400,000. So you've got some money sitting there that lenders will let you tap. Like you can borrow against the part of the home that you own. And so these are essentially second mortgages. The home equity loan is a type of loan with a fixed rate. A home equity line of credit has a variable rate. But if you need $50,000 to replace the kitchen, you can use one of these types of loans to do that. And as interest rates have gone up, these types of loans aren't super cheap. I mean, you might be paying 9 or 10% to borrow with a home equity loan or a HELOC, but it's certainly cheaper than putting the expenses on your credit card and having a 20% interest rate.
Man, but if you're remodeling the kitchen for $50,000, I mean, maybe just put that remodeling, put it off as long as you can, because I just really hate advocating for people to take out a HELOC or to tap into their home, because I mean, you're taking away money that you're, eventually going to have when you sell your house. That $50,000, that could be a lot of money. So
well, you're paying the interest on it too, so it's costly.
And you're paying the interest on it, yeah.
And it's always a risk, right? We have no idea what happens in the housing market tomorrow.
Yeah, that's right. I remember back in 2007, 2008, I mean, just driving down the road, I would see everybody with these beautiful fifth wheelers and, these high dollar trailers, and everybody's got these expensive vehicles. And I'm like, where is all this money coming from? Well,
what do you do for a living? Tell me your secrets.
I want to know. But they were all tapping into the HELOC and, borrowing money from their house. And then what happened? Everybody got underwater.
Everything goes sideways.
Yeah, they kept the toys because it was paid for, but they lost their house. So that's a conversation for another time, I guess, Jeff.
You have gone off on a tangent.
Let's talk.
No, that's a good point that you raised, though, because I did sort of cautiously endorse HELOCs, home equity lines, if you're going to use the money to do something for your house. Like if the bathrooms are outdated and you need to update them, if the kitchen really needs to be renovated, then yes, a home equity loan or a home equity line is a good way to do that. But I would say definitely do not tap home equity to go on vacation, to take a cruise, to buy a vehicle. You want to sort of match the value of and the lifespan of the money that you're spending that HELOC proceeds on to what you're actually spending on. So the kitchen or bathrooms should be good for 10 to 15 years. The cruise is over in a week, so
yes,
I would say there definitely is some common sense to apply.
Absolutely, and I mean, if you put the money in the HELOC, if you put that back into the house, just like you said, Jeff, I mean that's okay, but if you use it for anything else, not a good idea. Hey, before we wrap things up, let's talk about the minor repairs. Like the dishwasher, the washing machine, stuff like that. Maybe you're not really expecting it. I'm not a huge fan of extended warranties or these home warranties where they cost $600, maybe $700 a year. I like to advise people that forget that and just put like a monthly amount away every month, kind of like a repair fund, so it's there and you don't get caught off guard. What do you think about that?
Exactly. Yes, I do agree with you on extended warranties. They're regulated and classified as insurance. And they're a very profitable line of insurance, unlike auto insurance or homeowners insurance. And so that just tells you that it's not necessarily a great deal for the consumer. So I know a lot of retailers push warranties really hard. I would steer clear of warranties. I mean, as a rule of thumb, you want to insure things that you can't afford to replace. Like you want to insure your house, because if it burns down, you probably don't have $300,000 sitting around to rebuild. But if your $1,000 dishwasher breaks and you need a new one, ideally you've got enough money set aside for that kind of thing. I guess one exception would be if the seller of your home provided a home equity, or I'm sorry, a home warranty as sort of an incentive. I don't know if sellers are doing that anymore in this crazy market. They don't need to provide many incentives at all. But if you happen to inherit a home warranty from the previous owner, then by all means use it. But I agree with you. I would prefer that homeowners just save some money and self-insure for those kinds of smaller, minor repairs.
Yeah, if the seller is going to buy and pay for it, okay, yeah, that's fine. Throw it in. But I just don't like advising people to pay out of pocket.
And Gary already offered up his services to repair things like dishwashers.
I did tell you I was not very handy, but
but you said you can do it.
Well, listen, let's not get crazy here, okay? I don't have a tool belt.
I want to see him up on your roof with his YouTube.
Wouldn't that be
I'd
great?
replace your roof.
Wouldn't that be
I'm
fantastic?
going to be up there with a hammer. Do you really want me replacing your
so
roof?
much money? I don't know. Probably not. No.
Oh man.
We'll start with a smaller job.
We'll get back real quick to the extended warranties, and that is, I have come over the years to realize they look for any little excuse to get out of paying for it.
Do.
And I'll give you one example, and we'll wrap things up. Dishwasher. This was a story that I did. Guy had a dishwasher. It was out, and the extended warranty. He called, and the extended warranty company told this homeowner that, well, do you have maintenance records on the dishwasher?
Of course not.
Of course not. But
who does maintenance on a dishwasher?
Thank you. Nobody does. You know,
I put the dishes in, it washes my dishes, and then we're done.
Well, you got to clean out the drain every once in a while, but you're not going to get somebody out there, some dishwasher pro, scoping, and then give you paperwork so you can provide to the extended warranty company. So,
that's nonsense.
Yeah, that's another conversation for another time. So, Jeff, thanks so much for being on the On Your Side podcast. A great conversation. If people want to find out more about you or Bankrate, just give us some websites and social media accounts.
Yeah, just bankrate.com. I'm on LinkedIn at Jeff Ostrowski, and I'm on X at Bio561.
Sounds good. Thank you again, and we appreciate you being on here.
All right. Well, thanks a lot. Enjoyed it.
The On Your Side podcast is produced by Brad Denny. Our audio engineer and editor is Todd Martin. Segment producer is Colin Stanton, and I'm Gary Harper.
And I'm Susan Campbell. If you have a problem you can't resolve, maybe we can. Send us a message through azfamily.com or our AZ Family mobile app. Look for the On Your Side section and leave us a message. Thanks so much for listening to the On Your Side podcast. And if you like it, leave us a review. We'll see you next week.
On Your Side is on Good Morning Arizona every weekday morning at 6:45 and 7 o'clock, and every weekday evening on Good Evening Arizona at 4 and 5 o'clock. You can also catch it on Arizona's Family News at 9 on 3TV every weeknight.